Paycom Software, ticker PAYC, is a company that one of the few super investors, Bill Nygren, added in Q1 2024. He has increased his previous position in PAYC by 181.18% and is now sitting at 6% of his overall portfolio. The company is also currently trading at its 52-week low, and therefore today I want to jump to my stock valuation spreadsheet and figure out PAYC's intrinsic value and look a bit more into its fundamentals. So jumping to our stock screen, I will plug in the ticker PAYC and all the metrics will show up automatically after I press enter. And right away we can see that the current dividend yield for the company is sitting at 1.04%. And it has a dividend payout of $1.5 per share per year and a very low trailing free cash flow payout ratio of only 6.56%, which lets it use a lot of its free cash flow for share buybacks, paying back debt, and expanding the company. You can see that the current price of the company is sitting at $144.20, and that its 52-week low was at $142.41 just a few days ago. Now the institutional ownership is sitting at almost 80%, which is always nice to see, and the beta is sitting at almost 1.2, which means that PAYC is slightly more volatile than the overall market. Now for those of you that don't know, PAYC is in the technology sector and is a company that provides online payrolls, and so is very well set for the future to come. And of course, if you find these spreadsheets interesting or helpful, you can always download them at my Patreon in the link in the description. But now let's figure out PAYC's fundamentals. So we will jump to our 9-pillar analysis, and right away we can see that the 5-year PE ratio for the company is sitting in the red and is sitting at 86.4. We generally want the P5-year PE ratio to be sitting below 22.5, which would mean that the company isn't overvalued compared to their earnings. But if we scroll down to the financials, we can see the P ratio right here, and we can see that over the past 5 years, the company has actually been lowering their PE ratio extremely well, and that in 2023, the PE was actually sitting at 17.63, and if we scroll up, that is actually in the range we like to see. Now we can also see that PAYC has been increasing their revenue, increasing their free cash flow, and increasing their net income overall by about 20% year over year, which is phenomenal. They also have a 5-year profit margin sitting at 84.67, almost 85%, and they are buying back shares, which I always love to see. And their long-term liabilities over their 5-year free cash flow negative dividends is sitting at only 0.39, which means that they can pay off all their long-term liabilities in about 3 to 4 years, which means that they really won't have any troubles getting into debt. And finally, the company did start paying a dividend only about 2 years ago, and they haven't increased it since, so the consecutive dividend growth is sitting at 0%. Now, if we scroll to the financials and have a look at the graphs, we can see that the gross profit margin is actually very stable over the past 5 years. We can see visually that the revenue and the net income are both increasing, the free cash flow is increasing, shares outstanding are decreasing slightly. We can see that the long-term liabilities are increasing, but not by a whole lot. And if we scroll a bit up, we can see that the free cash flow is actually increasing at the same rate. So there really shouldn't be an issue with the long-term liabilities increasing. Now scrolling all the way down, we can see that the earnings per share as well as the free cash flow per share are both increasing. So that is phenomenal. Now let's calculate the intrinsic value of the company. So let's jump to our Graham's formula. And here we will use this specific formula. We will take the earnings per share and multiply by the sum of the base PE and the multiple of the growth rate multiplier and the 5-year growth estimate. We will then multiply everything by the average yield on AA corporation bonds and then divide everything by Y, and Y in this case is the yield on AA corporation bonds, which would be sitting at about 4.02. Now currently the yield on AA corporation bonds is sitting at about 5, but the short-term average would be sitting at about 4.02, so that is why I use this value. And when we calculate it using this formula, we get an intrinsic value of $294.22, which is 51% higher than the current trading price, showing that PAYC is indeed undervalued compared to their current earnings. But now let's jump to our second valuation method, which is the discounted cash flow method. And to carry out this analysis, we will take the free cash flow over the past 5 years and calculate the average growth rate to be sitting at 23.37%. We will then compare it to the analyst growth rate projections over the next 5 years, and I will plug in my own calculated growth rate into the future, sitting at 10% year over year. And using that, I will calculate the future free cash flow, and then plugging in a discount rate at 8%, I will calculate the present value of that future free cash flow. I will then sum up all that present value of that future free cash flow, add any cash and cash equivalents, subtract total debt currently sitting at 0, and get an equity value, which I will divide by the shares outstanding, and get an intrinsic value at $150.17, which is about $6 higher than the current trading price. Now moving to the multiples valuation, and here is the place where we compare PAYC to its competitors and really figure out how it's doing against its peers. So I will take the peer stock prices, divide by their earnings per share, and get their PE multiples. I will then average these out and multiply by the earnings per share of PAYC and get an intrinsic value which is more than $60 higher than the current trading price, sitting at $208.86, showing that PAYC is undervalued compared to its competitors. And now moving to our final valuation model, the dividend discount model. And here, as PAYC didn't raise their dividend at all over the past years, we cannot properly evaluate and calculate the projected growth rate. But as I do think that PAYC does have a fairly low free cash flow growth rate, as we saw before in the stock screener, I will plug in a projected growth rate of 1% to be conservative. But even when I plug in a projected growth rate of only 1%, the intrinsic value would come out at $21.81, as the projected growth rate is much lower than the WACC of the company. And for such cases, I have my alternative discount model, which takes the next year's dividend, the stock price predicted by analysts, and the WACC of the company. The next year's dividend is calculated by our projected growth rate, and using this method, we will get our intrinsic value to be sitting at $206.26, which is very similar to our multiples valuation. And after carrying out this valuation, we can jump to our ultimate valuation, where we will average out these 4 valuations we just did and get an intrinsic value of $214.88, which is 48.8, almost 50% higher than the current trading price of the company. And if I plug in a margin of safety of 20%, we would get an acceptable buy price at $171.90. And say if I want to plug in a margin of safety of 25%, I would still get an acceptable buy price at $161.16. And there you have it. We have most probably figured out why Bill Nygren is buying into PAYC, and that is that one of the reasons is that it is currently undervalued by a whole lot. Now, I'm not saying that you should or shouldn't buy the company. I'm just trying to teach you a process of how to value any company. And so if you did enjoy the video, make sure to leave a like. And if you want to download these spreadsheets, make sure to head to the comment section and go to my Patreon, which I have pinned in the comments.